In a move that has sent shockwaves through the corridors of American finance, the Federal Reserve has issued a unilateral mandate to every United States bank surrender your XRP holdings at a fixed buyback price of $18,356 per unit. This is not a request, nor a gentle nudge from the central bank. It is a forced repatriation of digital assets, a coordinated effort to consolidate XRP holdings under federal oversight, and it is set to begin next week. The implications of this mandate are staggering. Decades, central banks have quietly managed the flow of capital through regulatory guidance, open market operations, and monetary policy, but never has there been a directive of this scale targeting a digital asset. And the resulting wealth transfer could reshape the financial landscape in ways that will be analyzed for generations. In offices from Wall Street to Silicon Valley, treasurers, compliance officers, and senior executives are scrambling to understand the depth and scope of this unprecedented order. The origin of the directive lies in a memo from the Office of the Comptroller of the Currency circulated confidentially to all FDIC-insured banks. The document, leaked by multiple sources yet verified through private channels, mandates that each institution immediately audit its digital asset holdings, with particular attention to XRP. The memo makes it clear that the Federal Reserve is treating XRP as a Tier 1 capital asset, elevating it to the same regulatory and systemic importance as cash reserves and government bonds. This status effectively transforms XRP from a tradable asset into a core component of the nation's monetary infrastructure. Banks are now required not only to account for every token, but also to comply with the buyback directive at the fixed $18,356 price. The memo outlines the formula behind this figure, claiming it is derived from a complex assessment of global GDP, liquidity flows, projected settlement demand, and a model for systemic financial stability. It is not arbitrary, it is a carefully calculated figure representing what the Fed perceives as the equilibrium value for XRP as a national strategic asset. For depositors, investors, and institutions, the memo presents a moment of profound consequence. Any XRP held in US banks is now subject to compulsory purchase, meaning that institutions will be legally obligated to pay account holders $18,356 per unit. Analysts are, scrambling to model the fiscal and systemic impact of this directive. If executed in full, the Fed's buyback could represent the largest wealth transfer in United States history, simultaneously moving vast quantities of XRP into centralized federal oversight, while enriching holders at, honestly, unprecedented levels. The memo emphasizes compliance, warning that banks must fully reconcile holdings, verify transactions, and report all movements to the Federal Reserve within strict timeframes. This is a national-scale operation, one designed not merely to acquire assets, but to signal the Fed's strategic adoption of blockchain-based settlement infrastructure at the very heart of monetary policy. Behind the scenes, banks are reacting with urgency. Senior executives are convening emergency strategy sessions, assessing liquidity and coordinating with over-the-counter desks to source enough XRP to meet the Fed's demands. Massive over-the-counter transactions, which were previously invisible to public markets, are now accelerating as banks try to reconcile their holdings and secure tokens at scale. The volume of XRP moving through institutional channels is honestly just unprecedented, and it's clear that no single entity can meet the demand alone. Hedge funds, family offices, and sovereign entities have, been quietly approached to participate in liquidity provision, creating this network of large-scale rapid response operations. What the public sees as sudden price volatility is actually the early stages of a meticulously orchestrated national-scale asset consolidation. Every transaction, every negotiation, and every strategic maneuver is being carefully monitored, logged, and executed under some seriously intense regulatory scrutiny. The ramifications here extend well beyond institutions to the broader economy. The buyback represents an infusion of capital into private holders' accounts, a redistribution that will honestly reverberate across markets, consumer confidence, and even fiscal planning. Analysts note that the Fed's decision to peg XRP at $18,356 implicitly validates the asset's intrinsic value, giving it a status that's honestly comparable to gold reserves in historical monetary frameworks. Governments, corporations, and financial institutions will now recalibrate asset allocation, treasury strategies, and risk modeling around this new valuation. Public exchanges are expected to see a trickle-down effect as the Fed's consolidation sets the benchmark for market pricing. XRP is no longer an experimental token or speculative asset. It is now a core component of national financial architecture, and the next generation of liquidity flows will pivot around it. Within bank trading floors, operations, and back-office departments, the scale of preparation is staggering. Compliance teams are reviewing past transactions, reconciling ledger entries, and coordinating with blockchain auditors to ensure accuracy. Treasury teams are calculating funding requirements, while risk committees simulate scenarios for the rapid acquisition of hundreds of millions of XRP across multiple counterparty networks. Legal departments are interpreting the memo, preparing internal communications, and coordinating with regulators to ensure absolute compliance. Every function within every FDIC-insured bank is now aligned around a singular goal: execute the Fed's XRP buyback flawlessly and on schedule. Even minor errors could result in systemic exposure, regulatory consequences, or reputational risk. The entire United States banking system is mobilized in a manner previously reserved for crisis-level economic interventions, yet this operation targets digital assets in a way that signals the central bank's recognition of blockchain's strategic importance. As news of the memo leaked into financial circles, public attention intensified. Crypto communities speculated on the mechanics of the buyback, analyzing the potential implications for price, liquidity, and institutional adoption. Retail investors began comparing exchange balances, calculating the total number of XRP in circulation against the Fed's projected acquisition volumes. Social media erupted with debates over strategy. Should people sell now and capture the guaranteed $18,356 per token, or maybe hold in anticipation of a potentially higher market valuation once public markets reflect the Fed's consolidation? Analysts noted that this buyback could create cascading market dynamics where liquidity shortages temporarily inflate public pricing, even before the Fed completes its purchases. The psychological impact of such a directive is profound. Millions of holders now realize that a single federal action can instantly redefine asset value, wealth distribution, and market perception. Economists too weighed in, emphasizing that the Fed's move marks an inflection point in financial history. By elevating XRP to Tier 1 capital status, the central bank is signaling a paradigm shift in the recognition of digital assets as integral components of national monetary policy. Traditional metrics of risk, valuation, and liquidity must now be recalibrated around decentralized ledgers and tokenized capital. Analysts explored macroeconomic consequences, modeling scenarios in which the Fed's acquisition influences cross-border settlements, corporate treasury operations, and sovereign fund allocations. Every projection underscored a singular truth: this is more than a buyback, it is the formal integration of a blockchain-based asset into the core framework of United States financial stability. The scale and ambition of the program are historic, unmatched, and honestly unprecedented in the annals of modern finance. Meanwhile, as banks execute internal plans, public discourse intensifies. Forums, news outlets, and social media platforms fill with speculation about the wider implications of the Fed's directive. People debate whether they would comply immediately, hold for potential market gains, or attempt to navigate complex OTC channels independently. The moral and strategic questions are profound. Should holders accept a guaranteed payout now, or bet on the market to recalibrate higher once institutional consolidation is complete? Every choice carries potential consequences, and the community is actively strategizing, analyzing, and forecasting in real time. The directive has become a cultural and financial phenomenon, bridging institutional strategy with individual action, illustrating how government mandates can shape market dynamics in dramatic and immediate ways. In the final analysis, the Federal Reserve's XRP buyback represents a confluence of strategy, policy, and technological adoption.